All right, everybody. Hey, welcome to our next city in the Note Nation Top 40 Tour as we roll into OKC, Oklahoma City, Oklahoma. Honored to have you guys join us here tonight. Whether you're joining us live or catching the replay, feel free to ask questions. We're always glad to monitor those questions and get back to you in a very timely fashion, whether it's live or on the replay. So, encourage you all to ask questions as we discuss things on the residential and the commercial side and kind of talk about where the market is right now. But we've got a variety of different cities that we are covering over this 40-city tour. Oklahoma City is roughly the 70% mark of where we're at. And the rest of the way, we've got, I think, about 12 cities left. There's a variety of local and national investors that are keeping an eye out what's going on in Oklahoma City. You can always check out the full schedule and the replays from each of the cities at notenationtop40.com. Check them out there, ask questions, comment. Feel free to share the videos as well, too, for you. But we'll be discussing statistics and some different numbers that are going on economically in Oklahoma City. We'll talk about future opportunities. We'll talk about where to look for those deals and how to get started and tap into them tonight. But anyway, guys, my name is Scott Carson. If it's the first time you've seen me, welcome. Honored to have you guys. I've been an active real estate investor since 2002. I am the CEO of WeCloseNotes.com. You can find out all our different education and opportunities available there at the website. I've purchased in the past 10 years over $500 million in debt. I have been teaching and working with investors like many of you guys out there on distressed property since 2004. In the last 3 years, I've been the host of the popular and nationally syndicated podcast, the Note Closer Show podcast, that you can actually download anywhere that you listen to podcasts. And I invest all across the country, but I'm a little south of Oklahoma City. I call Austin, Texas home, another shade of burnt orange, I guess you could say. But anyways, our mission has always been to help investors to accomplish their goals and dreams and increase their wealth through what I think is the biggest opportunity in debt investing, by buying the debt and becoming the bank. And many people have asked me, why am I doing this? Why am I spending hours out of my schedule each day working on specific markets? Because I believe a couple things. Well, first and foremost, I do love to help investors, and I think planting the seeds now so that people are aware of what's coming down the pipeline, what's happening here in the near future, is a great way to help people out there. I also love to help people solve problems out there, and I think there are a lot of people facing problems with unemployment and forbearance agreements and commercial defaults and business going out of business, so I love to try to help people in any way or fashion that can help solve problems. I do believe, as I mentioned before, I do believe that's what's going on right now, and it's what's going to happen the next 24 to 36 months is the opportunity that we've all been waiting for. Many of us that were able to go through an opportunity a dozen years ago and make a lot of great things happen from what happened in the Great Recession, the opportunity has re-arrived and history is repeating itself. And I also am a little empathetic towards the people that are facing in struggling times right now, because at one point I was a distressed borrower. I was once facing foreclosure for being laid off. So I understand what's going on. I understand the emotion, and my goal is to help people out there. All right. Because there's nothing greater than in life than helping someone overcome an obstacle or achieve a goal or dream that they thought was once impossible. And we've all had that dream. There's been a lot of people that bought a house that thought that was once impossible. It was a dream of theirs. They achieved it. Now suddenly them being laid off is now turned into a nightmare, and they need somebody to help them out with that. And that's what I'm here to do. And I would love to have you guys help me accomplish our goal by helping over 1,000 investors in the next 12 months accomplish their dreams of becoming a real estate investor or enhancing their real estate portfolio through what's going on right now in the market. So let's dive into where are the opportunities. Well, the opportunities are literally everywhere, ladies and gentlemen. And I don't care what asset class you're in. I don't care what asset class you're dealing with. There is a lot of opportunity out there, whether it's dealing with self-storage, the apartments, the single-family homes, the mobile home, affordable housing has always been a big thing, or maybe it's offices, or maybe it's hotel motels out there. Whatever it is, the opportunity is good for everybody, because what's going on right now has no bearing on how old you are or young you are, color of your skin, whether you're a business owner, an employee, a failed in the past or successful in the past. It does not matter. The opportunity exists now for everybody. And that's the beautiful thing about what's going on is you don't need to have great credit. You don't need to have millions of dollars in the bank or even hundreds of thousands of dollars in the bank to tap into what's going on right now. The opportunity is an equal opportunity. If you can come to the table and make some things happen, hey, the banks will be willing to work with you in a variety of fashion. Trust me, I'm proof of that, of what happened over 12 years ago and what we've gone to today. So let's talk about it. Whatever your goal is, because we've all got goals. 2020 has been a bit of a pisser of a year, I think we would all agree. But the thing is to keep in mind is that we've all got goals that we want to accomplish, long-term goals. Yeah, maybe a hiccup here or there, but we've got long-term goals. Maybe it's to sit outside on the beach in retirement drinking more margaritas and pina coladas and getting a tan. Maybe it's to spend more time with your spouse, retiring your spouse from their job, one or two, whatever it might be. Maybe it's to pay your kids through college, help them go to the college of their choice with everything in the upward. Maybe it's to take you and retire your mom or dad who are still working, who've helped support you along the time. Maybe you want to travel more with your friends and family, see some exotic places. God knows I'm missing travel right now. But maybe it's just the fact that you want to upgrade your digs, update your crib, create more wealth, add more real estate to your portfolio. Whatever it might be, those are all great goals. It doesn't matter. There's one thing that all those goals need, and it needs money. Whether it's you're paying for it, or it's money coming in to pay for it, the other people's money or cash flow, you need to have cash to do that. And you know what, ladies and gentlemen, if you're sitting at home struggling or have friends struggling, you know what, this is an opportunity right now. You've got a good 6 months. You've got 90 days to get rocking and rolling, to understand and hone a craft that you can really make a lot of good happen, not only just for yourself, but for the bars out there. But put a lot of that green Benjamin Franklin's in your palm of your own hand to do what you want. All right? It's an opportunity of a lifetime. And so let's talk about what the opportunity exists and what the national numbers say out there. Now, sometimes it can be a little sad with what's going on in the market right now. We're at 1 out of every 9 people is unemployed, with an unemployment rate of 11.1%. Over 50 million people have filed for unemployment since it started. 52% of small businesses are expected to fail. 1 out of 10 homeowners was already struggling to stay current before the pandemic hit. Yes, 1 out of 10 was already 30 days late. Now we look at what's going on now. That number's gotten worse to where we see 7.76% national delinquency rate. That means 1 out of 12 borrowers at least 90 days behind past the delinquent status, and we're going to see that number actually skyrocket here over the next 90 days too. Currently, 4.1 million Americans are currently in default. That's represented in that 7.76 number. But they say there's probably another 4 million borrowers out there that are on the verge of going delinquent over the next 90 days. Now, if you think about this, looking back at history, it took us 18 months when the Great Recession started for us to hit 1.6 million defaults back then. Well, we're 2.5 times that, 3 times faster. If you don't think it's going to get worse, then let me help you pass the crack pipe on down to somebody else, because nobody's talking about this. Nobody's talking about this at all. They're all worried about the small amount of debts. They're not talking about the borrowers in trouble. They're not talking about the banks that are facing difficult times as well. And so be prepared. There's going to be some tough decisions to make, and I would rather have you be on the good side of the decisions versus the bad side. Lenders are bracing literally right now. They've had the benefit of being able to figuratively kick the can down the road for 6 months with forbearance agreements, especially on a lot of the government-backed loans. But lenders are bracing for up to 15 million mortgage defaults out there again, everybody. Now, you look at what's going on in Oklahoma. Let's bring it back a little bit to locally there for you guys. Oklahoma is actually doing quite well when it comes to the housing hardship index. This is a index put on by bank rate, and they take a look at the unemployments, the default rates, and then they kind of rank the states in a 1 through 50 level. Well, Oklahoma ranks not so bad. Unemployment's actually less, 6.6%, one of the lowest unemployment rates in the country, which is good. The delinquency rate is right there, just a little bit below the national average, 7.61%. Now, a lot of that is due to the oil and the natural gas stuff. That's why I was a little surprised to see the unemployment rate lower than the national average in Oklahoma when I was doing this, but that's okay. Oklahoma ranks 38th nationally on the low side when it comes to housing hardship. It's a very affordable state. Median average price point in Oklahoma City is about $180,000 in housing, okay? Now, if you look at the unemployment rates, how it compares around Oklahoma City as of July was basically at 7% in June. Canadian County, 6.9. Cleveland, 6.7. Grady, 6.5. Oklahoma County is at 7.3. So you see how it kind of rolls out through June numbers. July's numbers aren't out yet, okay? But you can see, okay, Oklahoma City, that is right on par with everybody else around there for the most part. Now look at the number of foreclosures, auctions, and bank-owned stuff. That number is up a little bit over last couple months. You can see how it kind of dropped off there in March. The numbers went from higher to nothing, and it's kind of flatlined as far as pre-foreclosures because nobody's starting the pre-foreclosure process yet. They're still giving people opportunity. Saw a little bit of a spike in May with the auctions. That number dropped back down. And of course, bang out numbers are going to be a direct inverse relationship to the auction aspect of it. So you see a little bit of that ticking back up there. Obviously, you see kind of a drop off a map in March, up in a little up in April, being a low point, up in May, down in June, back up in July a little bit there. This is the first one that had a little bit in July there for you. But Oklahoma is has not really implemented any policies related to evictions and foreclosure in response to coronavirus. This is a map that kind of outlines the dark greens of states that did statewide moratoriums, the lighter green, local moratoriums, a very, very faded green. Evictions have resumed, and no state or local moratoriums were stopped. So Oklahoma didn't say anything. They're like, hey, it's normal. Don't care if you got to stay at home. We're not going to stop the foreclosures for you or evictions. You can pay your rent. So kind of be that as well. Now, of course, we had these 6-month forbearance timeframes by the government-backed loans. Same thing. President Trump did the same thing just a few days ago. Now we're going to extend it through at least August 31st on a lot of the Fannie and Freddie stuff. So that's a good thing. But you also have to realize, too, that if you're a renter watching this and you're in a property that does have a government loan attached to it, that eviction moratorium nationally does apply to you. Now, if you don't know, you can check it out by doing a search on the FHA or Fannie Mae government website out there to find out if the property you're at is secured by a government loan. Now, gradual return of foreclosures. This is through middle of July. Oklahoma's been about 5% where it was beforehand. Not as extreme as some of the other states out there, slowly getting back to normal. And that's leading a lot of people to realize, hey, are we going to see this huge wave of foreclosures and evictions as values drop from foreclosures? Yeah, you're going to see some. It's going to vary on a state-by-state and market-by-market basis. You probably won't see that many in Oklahoma initially, let alone Oklahoma City, because of obviously the bank's kind of kicking the can down the road. Now, what loans are in the biggest type of defaults? You know, what type of loan products are having the biggest problems? Well, this chart shows kind of what is a breakdown. The FHA loans in the green there are at 9.69% default rate. Basically, 1 out of 10 borrowers in the FHA, that's usually a first-time home buyer buying a new house. That's the ones that are struggling the most because, A, they got the least to put together. Also, it's kind of a subprime loan when you look at the fact that a lot of the banks for the last 2 years, 3 years have been donating the down payment required by 3.5% by the FHA. They've been donating that and paying it, and then also paying upwards of $10,000 towards closing costs. Bank of America has been doing this all across the country, and we'll talk about where Bank of America is. On the opposite side of the scale, your traditional conventional loan is at 3.16 default rate. Not very bad, but still higher than what it was as a national default rate was back in February. Your VA loans are at 4.65, and then the other loans at 4.36 out there. Now, we all know and hear about forbearance agreements across the country. That number continues to stay strong, roughly over 4 million, 4.5 million, roughly somewhere around there. Economists, though, and the mortgage professionals say there's probably another 4 million borrowers out there, though, that have not filed a forbearance agreement because the fact is they just don't want to call the bank. They just don't know their options, and they're scared to do that. So that's this 4 million we'll see delayed on the residential side going down. This obviously doesn't apply to commercial property, but this is why we think the residential side is going to be dragged on for a while before you start seeing a massive amount of foreclosures, because the banks will have 6 months to evaluate their portfolios and decide who's on the naughty list, who's not going to pay, who's on the nice list, who can pay, right? So is that good news or bad news? Well, Oklahoma does have a lower default versus the national average, which is great, but it does have longer foreclosure timeframes. It's a judicial foreclosure of 690 days to close as a Fannie Mae loan, FHA loan, okay? That's a long time, okay? If the FHA and the government-backed loans are going to give 12 months in potential loan forbearance agreements to borrowers, they're literally kicking the can out. And then it's going to take you almost 2 years to foreclose. If it's an FHA loan, you're not going to see anything anytime soon on the residential side, okay? That's not good, okay? It's going to be a while before you're a traditional real estate investor who's going to go buy REOs and fix and flip them up, or I'm going to turn into more rentals. It ain't going to happen for a while, ladies and gentlemen. I'm sorry to say that. Most of that stuff is going to end up being sold off from one bank to a different bank or different investment institution out there that's not going to hit your foreclosure market, okay? It's just not going to do like you would think it would. not saying we won't see a spike in what we've seen in the past. It's just not going to be as dramatic for your traditional one-off mom and pop investors showing up at the foreclosure auctions. And then you add in the troubles with the oil and the natural gas industries and a lot of those companies being distressed, it's going to get worse that way as well also. Now, let's talk about the commercial debt a little bit here, everybody. This is where I think a lot of the opportunity lies. We see for sale signs. We see for lease signs. We see businesses going out of business. We see companies filing bankruptcy at record levels out there. I mean, if you've had your ear to the grindstone, I think commercial real estate has been overpriced for a while, and the banks have been financing a lot of stuff that I think has been really overpriced, especially looking at the multifamily market, some of the others, way overpriced. Now that's ended up biting them in the butt. Okay, when you start looking at the default rates of different asset classes in the commercial side, you see obviously a huge spike in hotels. You see a big spike in retail. You see others that's like restaurants and some of the other mixed use stuff is also taking a big hit out there across the country. Now, when you look at the U.S. metropolitan areas by delinquent balance, especially the top 15 markets with the biggest amount of CMBS debt, Oklahoma City is not in there, but Dallas, just south, has roughly about 10% of their properties that are in the CMBS are in default. Definitely delinquent balance, almost $1 billion. Okay, Houston right at $1 billion. You're going to see a lot there in Oklahoma City also take a bite in a variety of things. Not only the CMBS side, but then also on the bank side of things, the bank finance, not the Wall Street or CMBS finance stuff. Now, 1 in 4 hotel loans in default, 1 in 5 retail loans in default, 15% vacancy to increase in retail and restaurant space. That makes that a very bad market to be in right now. Office vacancy is set to increase to roughly 20% nationwide. That's going to affect, obviously, Oklahoma City. You're expected to see rents drop by 10 to 15% by the year end and continue into next year. Now, what does that mean? Well, if you've got vacancy increasing, rents falling, that's not good. That's going to affect your value of your property pretty dramatically. Now, looking at who and what is financed what. 10, 12 years ago, it was a lot of the Wall Street guys financing roughly 2/3 of all the distressed debt. Now it's been a different type of market now where the banks have gotten in and gobbled up that stuff and financed roughly 53% of the distressed loan space right now. Now, just the tip of the iceberg, as some of the experts say out there, what's going to hit the market in default. It's a whole other wave. They're saying that it's only the tip of the iceberg for that. Now, if you look back at what happened in February and March, the CMBS market lost $50 billion in value in just a few weeks because the stress stuff and people going out of business and businesses shutting down. That market's come back some, but not near what it used to be. Now, looking at what's been financed by the banks these days, banks aren't like doing traditional loans like you would on a single family home at 90 to 95, 97%. They're much more conservative on the commercial side where they're financing roughly at 60 to 70% of the as-is value based off the cash flow and comps and cap rates and stuff like that. Well, here's the big thing. If they want to be at 70% or less and your value of property has dropped by 20%, that means their LTV has gone up by roughly 15 to 20%. If your rents have gone down, your cap rate has also gone down. So the banks are giving borrowers time and tenants time to get back on track. But after 6 months, especially here at the fourth quarter, they're going to start asking these borrowers to start bringing cash to the table, 10, 15, 20%, to write down these loans to do an appropriate and comfortable LTV level. Well, most borrowers, most property owners don't have an extra $1 million or $500,000 or $100,000 sitting around to write down their loan. So it's going to be a lot of defaults across the country. And you're seeing this already taking place in a variety of fashions out there. News. Now, what's the opportunity? Well, they may not be clearing this stuff as bad, but the biggest thing for you guys to do as investors is put some capital together and go out and buy some of these loans at huge discounts that makes sense for you to take these loans over and then either A, work with the current borrowers or try to reposition the property in a variety of ways. Now, repositioning the property is going to take a little bit of time. We'll get to that. But if you don't think the banks are hurting, look at the different news outlets coming out. They expected in July that banks stand to lose roughly $48 billion in commercial real estate. That's what they thought initially. Well, it looks like that number is going to be a lot worse because Bank of America alone, Bank of America, Wells Fargo, Citibank, and Chase just recently announced that they were going to be losing a lot of billions. Bank of America is set to lose roughly 5.1 billion is what they set aside for their sour and bad loans out there. That's their piece of the pie. Now, you look back just a few days ago when this article came out in DS News, it's a bad thing. The four biggest banks set aside more than 32 billion for loan losses in the second quarter. That's close to a record, okay? Signaling that the relief programs may not be enough to stave off a flood of bad debt, everybody, okay? Yeah, Bank of America, 5 million out of 32 million set aside. Now look at some of the other things out there. Wells Fargo, to give you an idea out there, consumer deferrals were on a combined 35 billion of first and second mortgages, representing 12% of their portfolio and 10% of each loan type, respectively. Okay, almost 9% of JP Morgan's residential real estate portfolio was subject to payment deferrals, representing nearly 3/4 of the total 28 billion of consumer loans in deferral. Ouch. Wells Fargo reported 44 billion. Okay, that reported only that it modified 38.2 billion commercial loans without disclosing the amount remaining in deferral by June 30th. Of course, Citibank modified about 20 billion in consumer loans globally. Bank of America, which provides figures as of July 23rd, was deferring payments on 7.7 billion in commercial loans. And get this, drum roll please, 28.5 billion in consumer and small business debt. The country's on sale, ladies and gentlemen. The country is on sale. All right, so where are the opportunities at with what we're seeing here today? Okay, there are opportunities. Is it in the foreclosures in the REO market? No, it's going to be a while before anything works out that way. But it's going to have to happen sometime soon in something, because the government cannot keep printing money. So the banks, while they may not be incentivized to move a lot of stuff immediately, they're already putting reserves away. If they've got to pull money back in reserves, they can't lend that money out. And that's how they make their money. Okay, is it in the fix and flip business? No, because you're not going to see a lot of distressed property, single family homes that you can step in and buy up. Hard money lenders have already been calling to see if we're looking at buying debt at a discount. Okay, plus the back end financing is dried up for a lot of these investment programs as well. Is it going to be in the rental market? Heck no. The Airbnb market has been killed. Airbnb says basically 6 years of growth was lost in 6 weeks. All right. Long-term rentals, no. Student housing, you don't know if students are coming back to school. I've got friends that say their apartments on student housing are down 40% than where it should be. People just don't trust going out yet. So where does the opportunity lie? Well, the opportunities lie in you becoming the bank yourself in the debt game. All right. We're going to see residential notes become available in the fourth quarter. Notes, not properties. What I mean by that? Well, the banks have had 6 months to evaluate their portfolio to see who's on the naughty list and who's on the nice list. The nice list are those that either A, have gotten off of forbearance or have been smart with their other debts. The naughty list are those that have asked for forbearance or asked for a second one going into the fourth quarter. And the banks should be looking to move that stuff off of their books in the fourth quarter. Commercial notes, though, we are already seeing deal flow this quarter. My buddies have talked about seeing more deals in the last in the last 2 months than they've seen in the last 24 to 36 months, everybody. That's where the opportunity is to become the bank, buy this stuff at a discount, 50% or less, and really turn it into some good. But the biggest opportunity is not going to be chasing the bigger assets. It's that smaller asset class of $2.5 million value or less. Now, that may not seem like a smaller asset class to many of you if you're buying $50,000 and $60,000 houses, but this is a huge overlooked asset because that's what the banks have gotten rich on in financing this stuff. The $50 million to the $5 million greater, that's all Wall Street. That's all CMBS guys. You can pick up a lot of assets at that $2.5 million in value mark for big discounts and then work it out in some sort of way with the tenants or the borrowers, okay? Now, you're going to have to be able to pivot if you look at these assets. Maybe you're buying a hotel and need to convert it to a apartment complex like this guy's done in Illinois, or like our guy Garrison Gilbert is doing in Pennsylvania and Maryland, taking some empty houses or empty hotels or closed down hotels and turn them into a multifamily. Maybe you need to take office buildings and turn it into self-storage like this guy's doing in Denver. You got to be flexible, and you have to be, as a local investor, there's a lot of opportunity for you to figure out what is missing in the market that you can take an empty big box store and turn it into self-storage or turn it into something else compared to what it was set for. Bankers are not very creative people, all right? And being an ex-banker, I understand. You look at what happened in 2008, where Chase Bank made 0 commercial loans in 2008 in the state of Texas. Yeah, that's all you got to know. There's opportunity for all of us. So let's talk about some of the banks in trouble in the great state of Oklahoma. Are there banks in trouble? Well, hell yeah, there is. One thing that we do and use on a regular basis is a service called Bauer Financial. And about what Bauer Financial is, it's a ranking system that looks at banks' assets. They look at their quarterly reports that they file every quarter to see what kind of distress they're in, how much in loans they have in default, and it ranks them from 0 stars to 5 stars. Now, we like to track banks that have 5 or more branches because now they're a little bit bigger of a footprint. Those banks that only have like 1 to 4 branches, really too conservative in their lending to really have any bad debt. I mean, they're still going to have some, but for the most part, we're looking at stuff that is in default. Now, if you look at North Carolina, we know that there's thousands of banks that lend in North Carolina. I'm sorry, in Oklahoma. Sorry, I should say Oklahoma. Okay, not North Carolina, but 51 banks lend in Oklahoma out there. They have, I mean, more than 51 banks have their offices. Their main offices are based out of Oklahoma, okay? And we know there's thousands of banks that lend there, but 51 call Oklahoma their main home. Out of that, those 51 banks have a combined $3.4 billion in 90 plus defaults across the board, and an additional $1.5 billion on that cusp of turning into 90 days, 30 to 89 day late. So you're talking roughly $4.9 billion of distressed stuff there. If you look at that average of 3.4 and divide it by the 51 banks, is 11.1% across the board average of a bank's portfolio's default. That's pretty high compared to other places out there. There is, out of that 3.4 billion, there's basically a third of it, 1.2 billion, is in 90-day defaults in single-family residences. So while the delinquent rate is lower in Oklahoma compared to others, these banks have stuff on their books, whether it's in Oklahoma or outside of Oklahoma, that's also going bad. Now, if you look at the 2 biggest culprits, MidFirst Bank has $2.7 billion in distressed debt, and out of that, basically a third of it is just in the single-family residence space. BOKFNA has $264 million total in distressed debt, with $176 million being a single-family. So they're much more of a residential bank versus a commercial bank like MidFirst is. But you can still see there's opportunities there, guys. If you can step in, buy the stuff at a discount, and then get creative with the borrowers. And why would you want to buy distressed debt? There's a variety of reasons. Now, for those of you guys that are looking for deals, if you're waiting to buy the real estate, I had a phone call today with a realtor who's like, oh, I'm ready for the REO stuff. I'm like, you're going to be waiting around for 12 to 24 months. If you really want to start looking at getting into the deal flow, you need to get in the debt game. He's like, well, that's where all that stuff ends up. So, or starts off at, I'll just wait. I'm like, well, keep waiting. Because if I'm buying the debt at a big discount, depending on the location, the foreclosure time frame, the values, the condition, what's going on in that market, what's going on with that asset class, I can buy my ticket to success, because the fact is I didn't originate it. I'm just buying the nightmare and turning it into a dream of a deal, because now I can get really flexible with a borrower. I can control the asset for a huge discount, especially because I'm in it so cheap compared to what was financed, what the original value was. Provided I'm going to need to probably hold on to it for 12 to 24 to 36 months to get it come back close to where it used to be. But still, 50% of as is value is not 50% of ARV or future values. And you can do a variety of different strategies: loan reinstatement, modification, short sale, payoffs, foreclosures, deed in lieu, cash for keys. You can take over the note and turn it into a cash flow or performing note, or if you want to add it to your asset base by taking over the asset and the property, you can do that and do what you want with it. Okay. The other advantages of note investing, this is a big one for most real estate investors out there. I know that people are tight on budgets. They're tight on spending things, and it often feels like you've got to spend a tremendous amount of money in marketing, direct mail, and other marketing to have any access to deals where people will call you. Well, that's the beautiful thing, ladies and gentlemen. We don't do any direct mail in the note business. It's a waste of money. We don't mail postcards or letters or go knock on doors. We're dealing direct with the banks. So we're using email, we're using LinkedIn Connect with asset managers, and we're picking up the phone and dialing for dollars. And the beautiful thing is that one source, one bank, isn't going to be just one note. It's going to be regular deal flow on a regular basis, every quarter in, quarter out, month in, month out. not just one property. Now I got to mail another 1,000 postcards and drop money on stuff that 96% of it I'm not going to see anything on. That's not the case with what we do in the note investing side. You can get the list that you get, the tapes that they're going to send you. You can cherry pick the best deals for your own portfolio. If you can buy in bulk, 1 or 2, 3 or 4, you can get better pricing. All right. You can do residential commercial assets from the comfort of your own home or office. As long as you've got internet and a phone, guess what? You can do this. And no, you don't have to work 40, 50, 60 hours at this. If you put in 10 hours a week into your marketing, you'll find deals sent to you. If you want to raise capital, great. If you don't have capital yourself, that's fine. Raise capital from other investors out there, go fund these purchases and give them a great return on investment. Because let's face it, to put $100,000 in a bank to make 0.1% or less, or 0.01%, I'm sorry, not 10%, but 1% is not a good thing. And if you don't think there's an opportunity, just look back to what happened 10 years ago. We have a tremendous amount of opportunity. And I think we owe it to ourselves as investors, as people, to go out there, not only make it good for us, but also help make the country, as I like to say, make America great again, one defaulted borrower at a time. And you can do that. Are there investors out there? By all means, yes, there are investors everywhere. If you just take a snapshot of what's going on out there, there's basically $9 trillion in retirement funds sitting out there, basically not making anything. And if you look at what's going on in Oklahoma City alone, not the whole county, but OKC, there are 21,000 investors with an IRA account in Oklahoma City alone. Out of that 21,000, 14,000 of them have at least 150 grand or more than their accounts. Hello? How many people do you got to talk to raise $1 million? Not too many. All right. You need to know what to say, what not to say. Okay. Maybe you're scared to raise capital. Oh my gosh, how do I raise capital? I've never done it before. It's not that hard. But let's just say you're not easy doing it. You don't want to do that. Okay. You want to just flip deals. Guess what? There's 17,000 people in Oklahoma City that call themselves real estate investors on their taxes. They claim as real estate investors. So plenty of opportunity for you to go find a deal and then either flip it to an investor or find an investor to fund your deal and take it down, ladies and gentlemen. And the question I always ask for you guys is, do you want to be the banker or the borrower? In most of your cases, all of you are the borrower. You've got a mortgage, you've got a car, you've got car payments, you've got student loan payments. You're the borrower. You're paying money out. You're on the wrong side of the note game. It's time to get on the right side and start having payments coming into you on a regular basis. And what you have to realize, ladies and gentlemen, is there is now a record amount of savings sitting in accounts out there as people are waiting for that rainy day. They don't want to invest in the stock market where it goes up and down and stuff like that. They're looking for ways to invest it to make money in something tangible. If you can pick up an asset at 30, 40, 50 cents on the dollar, there's a lot of things you can do to make money out there. And I'll tell you right now, everybody, the bank always wins. So why not get on the winning team? Why not become the bank? Why not have the same rights the bank does? All up to you guys. All up to what you want to do. So how do you tap in the tsunami of deal flow, guys and gals? It's not that hard. I've been working with investors since 2010, teaching them how to tap into distressed debts, whether it was residential, commercial deals. I've helped thousands of real estate investors purchase their first note, whether it's a reperforming, a performing note, a non-performing, a residential, commercial note. It doesn't matter. We've done it all. Okay. And if you're looking for cash flow, great. If you're looking to grow your asset base, great. You can do that. You can buy it on a one-off basis or in bulk basis. Now, you're not probably going to call Bank of America, Chase, or Citi and buy a one-off note, so don't call me and ask me about that. But there's plenty of other lending institutions out there that have stuff that they're on their books they're looking to get rid of. Banks you've never heard their name of that have stuff that they want to get rid of, okay? And you can do trades from $25,000 to $5 million, guys. We have done a variety of them. You don't need to have $1 million. You don't need to have $5 million unless you want to tap into some bigger stuff. That's okay. You don't need credit. The bank doesn't care if you're in forbearance agreement on your own house. They're not looking at your credit FICO scores. They don't give a shit about that. They don't care if where the money's coming from. If you've got other people to fund the deal, great. When can you close? Okay. You can start doing these deals without having to drop in $5,000, $10,000, $15,000 in direct mail marketing. You can do this, like I said, email address, a free LinkedIn account, and your phone. If you are just coachable and learn to say and what not to say when talking to these people. And you don't have to do 40 hours a week with this. You're not going to be spending, hours and hours and hours each day doing this. No, there's some simple things you can do to start having deal flow sent to you immediately. So whatever your focus is, I've talked about before, whether it is single family homes or apartments, hotels, retail office, self-storage, mobile home parks, there are deals in every type of asset class out there, everybody. And you can truly create win-win scenarios, not only for yourself, but for the borrowers that are facing difficulties, like the homeowners that are struggling to stay in their houses, that have been laid off of work or don't know if the jobs are going to come back. They're struggling. They want to stay in their house, and they just need somebody to help them out to give them some options. Maybe you're wanting to buy on the higher end or commercial side. Guess what? There's plenty of developers out there that have overdeveloped properties, and the banks don't want to carry that debt and are willing to sell that debt at a big discount to make it a win-win. Maybe you're looking for cash flow. Maybe you're looking for apartments. Well, I'll tell you what, that smaller unit apartment, 100 units or less, is going to be one of the most dramatically affected by COVID. It's not going to be the higher end stuff. It's going to be the smaller unit numbers out there, and you can find that stuff quite a bit on the different books that we're seeing already these days. So, like I said, you would start off, you do it big or do it small. Most investors will start off small because they're like, oh, I can only do so much with what I have. That was what our buddy Gene thought of. When we met him a couple years back, he was doing deals in Elkhart, Indiana, where he lives, basically doing a little bit of what he could afford and what he would make off the other one and put it to the other ones. We taught him the note business, and fast forward a couple years, he sends me a text message that he's closed on over 135 assets. He's raised over $13 million in private capital, which he was scared to do at the beginning. And he's made a whole difference in his retirement accounts. His retirement. He's never going to retire. He's always going to be doing something. That's the kind of guy that Gene is. But definitely a whole different outlook on long-term real estate for him. Laura Blunt done an amazing job. She was like many real estate investors out there, going to real estate clubs, trying to wholesale, trying to flip, trying to do an option, subject to deals, whatever kind of tools she could find to work in that market. She just recently moved to Maryland from south of Austin into her dream house on the water. She bought 15 deals in her first 18 months with us. All right. Big chunk of that was other people's money. And now she's getting ready to close on a trade of over 140, 150 assets for $4 million using other people's money. And these are performing notes at roughly 50% of value. It's going to be a life-changing trade for her. And she's doing it when she never thought she could do something like that a few years ago. Keith Collins is out of Ohio, has done a tremendous job as well. We taught him the note business. He's got some real estate experience, built treatment plants, worked with cities. I even think he was a mayor of a small Ohio town at one point. Learned the note business from us. In his exact words, he goes, Scott, 2019 was an amazing year. We made 7 figures off of what you taught me and what everybody thought was a down market for notes. It's not been a down market. There is distressed debt everywhere, ladies and gentlemen. And you can be like Keith, Gene, or Laura if you want to. Now, you may be sitting there like, well, I'm kind of brand new to real estate. I don't know where to begin. Hey, you know what? You can be like Raphael here. We all got to start. Big things all have small beginnings, ladies and gentlemen. And Raph is one of our students who is a very small beginning, but he's getting rocking and rolling. He's coachable. Now he's been business owner with an entrepreneur where he had 15 full-time employees in San Diego at his car detailing business that he started from the ground up. And I can tell you that it's been hit hard. He's basically had to shut down, lay off his staff because nobody wants to get their car detailed if they're not driving it. But luckily for Raphael, he started buying notes back in November, December after taking our training. We worked with him. He immediately bought 2 deals in the first 2 weeks of taking our training and then another 3 within the next 30 days and done a tremendous job. He's like, man, Scott, I love this business. I'm stressed out about my ex-employees. They're all going to find something. I may not reopen again, and I'm okay with that because I've learned a new trade, learned something new that I can apply, and I'm really looking forward to what 2020 has in opportunities for me. And he's like many people. All these guys get started learning the nuts and bolts basics from us, and we're really proud of that. We've helped educate a lot of people out there. I would say the who's who in the distressed note space has come through our training, and we're really proud of that fact because we have helped thousands and thousands and thousands of other real estate investors take their businesses to a whole new level by learning the note business and really capitalizing on what's available in the markets out there. And we'd love for you guys to be a part of that as well too. I said early on tonight that I want to have 1,000 note investors, help create 1,000 of them to really do a lot of good damage to what's coming on in the next 24 to 36 months. And I'd love for you to be a part of it. How do you tap into that? How do you become a part of that? Well, the first step would be to sign up for our Note Weekend training. This is a 1-day class that's online. We do it via Zoom. You can watch it from the comfort of your own home or office, everybody. And it's just an amazing, amazing class. It's yours truly teaching it. It's live, so you can ask questions back and forth. And it's absolutely an awesome time. Like I said, we usually host it. It's online, mini workshop. You're not going to learn everything about the note business in one day, let alone like a 3-day workshop, but you can learn definitely, as our students call it, the Cliff Notes version of note investing. A lot of our past students have come back through and said, oh my God, this is a great refresher. Great, great aspect of teaching the basics of note investing. Not talking over you, but literally sharing with you the do's and don'ts and what to expect and really how to tap into a lot of great deals out there. We live streaming on Saturday. It is recorded. I restream it on Sunday, so you've got the replay. So if you miss out on something on Saturday, you can watch again. Normally it's $97. We'll usually run from 9 a.m. to 5 p.m. in the afternoon. Sometimes we'll go later. Sometimes we end a little bit earlier. It's up to what each class is a little bit different because it is live and you have different people. We may have 50 people on one. We may have 80 on one. We may have 10 on another one. It is just varied and it's always varied. But if you go to noteweekend.com, you can see the basic outline of the day there if you scroll down a little bit. Like I said, normally $97. If you go to noteweekend.com, the next one's in just a few days for you guys to tap into, to join in, to kind of dip your toe in the water to see if note investing is something that you want to do. Now, what do we cover in the whole class? Well, you can see the schedule, but if not, go to noteweekend.com. But the very first part of the day, we talk about how and where to find notes. You'll walk out with a list of asset managers that you can reach out to that will show you what kind of percentage of defaults they have, what do they have on their books they're looking to get rid of, and a great way to know when to contact them and what not to say. What to say, what not to say, when to contact them, when not to contact them, everybody. We will talk to you also second half of the day about how to fund these deals with other people's money. We'll show you how to tap into local investors in and around you and how to get them excited about working with you. We'll talk about the different exit strategies to make money because there's a variety of different ways to create win-win scenarios that really give you a bigger bang for your buck on the deal flow versus, oh, I'm not just going to foreclose. No. Foreclosure is the last thing we want to do. And I'll talk about why it's important to keep people in their houses and why it's the best rate of return when it comes to time and money for you and your money. We'll also talk about the vendors and the team members that you'll need. There's over 10 hours of additional video links inside the training there for you guys to be able to watch at your own pace on our vendors and other things that are important to you with asset protection, lines of credit, servicing, and vendors. That you do need a team of vendors to help you out in this business because you're not going to be the one doing it all, and that's a beautiful thing. It actually works in your favor. All right, and we'll talk about that as well. We spent a big time talking about also different loan trading platforms, where to find deals today that you can look at residential and commercial deals and make offers without having to wait. We'll also talk about a lot of other things like marketing. I mentioned a little bit of asset protection, some other stuff there for you, but we cover a lot of stuff. And like I said, guys, I would love for you to register today at noteweekend.com. You get the replays, and you know what? We'll throw in a few other bonuses for you guys if that's not enough for you. Now, Note Weekend training class, like I said, is normally $99, $97. We'll throw in a one-day training of calling banks. This is where you get to be a fly on the wall and listen and watch me call banks for roughly 4 to 5 hours. You hear the conversations. You see who I call. You see how I communicate, connect with them. You ask questions back and forth. It's a beautiful training event that people really love because, like, oh, it's not stressful to call banks. Oh, you can knock out a bunch of phone calls in a couple hours. You can dial for dollars and really have a lot of great connections. That's normally $49 by itself, right? The Bauer financial list, the most recent quarterly list, we'll throw that in. That's usually about $400 value. That's a value in a loan to get that list a whole lot cheaper than you would expect, right? Then you add in that we'll also do a 30-minute phone call with you after the event to make sure you're on the right track. I charge $1,000 per hour consulting. Half hour, it's a $500 value. I just want to make sure you're off and running in the right direction and really making impact with what you've learned from us. We'll also throw in, if you've got the replays, if you've got a spouse or business partner that you want to attend, we include that as in there as well. We also throw in a very active Facebook group with over 900 members to help you in your business with networking, sharing deals, resources, vendors, helping you even raise capital or sell deals there. That's included there as well for you, everybody. But all together, bonuses, over $1,000 in bonus. I think over $1,500, $2,000 in bonuses, depends on what you value things. But all this, guys, is just for $49. We're dropping the price in half from $97 down to $49, or $99 down to $49 for you guys. We want it to be affordable for you. We want you to take action, and we want to train you on the basics there so that when we do have deals coming in, we can send them to you. we can have you take a look at the deals and then be able to evaluate them or say, Scott, I like this one. I want to buy that one. Great. Let's work together to make some great things happen. So all that's included for $49. You get signed up tonight, everybody. Tomorrow you'll have a link with you with the replays to the last class, replay to the last calling bank training. So you can start learning now versus waiting for a week or so for our next class to get started. And I'd love for you to be a part of this, guys. Whatever your goal is, to retire, to spend more time with your spouse, to put your kids through college, to retire your parents, to travel more, to upgrade your toys, your digs, your crib, whatever it is, we all know it needs money. And it's time, instead of you being the borrower, you being the bank, because we know the bank wins, everybody. If you want to learn how to become the bank and learn how to buy billions of dollars in assets for pennies on the dollar, then you need to show up to Note Weekend. That's your first step, everybody. And like I said, for $49, you can get signed up tonight at noteweekend.com. So sign up now, take advantage of the special pricing and the bonuses that we've thrown in. And we'll see you at the top, everybody. Any questions out there for anybody? I want to thank you for being a part of it tonight. And we look forward to seeing you all at our next Note Weekend workshop. Bye, everybody.